Hi, my name is Tom Brigandy, and I'm the Vice Chair of CFA Society New York's Board of Directors. I'm also the founder of CFA Society New York's Asset Owner Series initiative. Since its inception in 2015, there have been over 50 in-person Asset Owner Series events hosted in partnership with CFA societies across numerous cities in APAC, EMEA, and the Americas. Asset Owner Series events have been attended by over 6,000 in-person attendees and have featured over 300 leading asset owner and investment consultant executive speakers from sovereign wealth funds, pension funds, insurance company general accounts, family offices, endowments, foundations, central bank reserve funds, and institutional investment consultants that, at their time of speaking, collectively had over $70 trillion in fiduciary assets under ownership or advisory. The Asset Owner Series wouldn't be possible without our dedicated team of over 500 asset owner, investment consultant, institutional asset manager, and sell-side investment professionals who are scattered across every corner of the world that source asset owner and investment consultant speakers for the series. In light of COVID-19, CFA Society New York, in partnership with CFA Institute and Kaya Association, created the Asset Owner Series virtual keynote discussions to ensure CFA Society and Kaya Association members globally will still be able to access exclusive asset owner and investment consultant perspectives, despite not being able to convene in person. Each Asset Owner Series virtual keynote discussion has been live streamed to all 160 CFA societies, in addition to all Kaya members, via each organization's respective content portal. The format of today's virtual event will be 45 minutes of discussion. That said, I am very pleased to welcome you to our 9th weekly Asset Owner Series virtual keynote discussion, which is titled A View of the African Continent. Now, without further ado, it gives me great pleasure to introduce my dear friend and our moderator, Hubert Danzo. Hubert is the Chief Executive Officer of the Africa Investor Group. Hubert, the floor is yours.
Thank you, Thomas, for that great introduction, as ever, my good friend. But on behalf of Africa Investor, it's a real pleasure to welcome you to this CFA African Asset Owners Roundtable. As Tom mentioned, my name is Hubert Danso, and I am the chairman of Africa Investor, the African Union's Continental Business Network, CBN, and the CFA Asset Owners Advisory Council. And I will be the chair for this roundtable dialogue. This African Asset Owners Roundtable is designed to provide CFA's global membership and the partners of CFA who are working on this roundtable, especially institutional investors as part of the membership, with tactical insights on a broad range of topics, including infrastructure investing, investing in public and private markets, asset allocation strategies, manager selection considerations, and of course the cardinal do's and don'ts when investing as or alongside institutional investors in Africa. I mean, I lead one of the African Union Development Agency's Continental Business Network's institutional investor initiatives called the 5% Agenda, which is essentially a compact on and between major institutional investors, pension funds and sovereign funds, where we come together and look at co-investment opportunities across the continent and work with our heads of state and government, public sector policymakers on the policy environment that we would like to see as it relates to infrastructure. So these are some of the different types of innovations where we're finding institutional investors in the continent are really not only using the capital, but we're also using our human capital to work with the public sector to crowd in our institutional investment, but also create a more predictable environment for us to be able to deploy to infrastructure, and of course, really create that better alignment with our own investment policy statements or risk-adjusted return criteria. And I think it's very similar to what we see all around the world: Australia, Canada, Gulf states, and other key continents. So this is just a sneak preview of some of the issues that we will be discussing today. But to take us through this roundtable, as ever, I'm privileged to be joined by an elite and distinguished group of my friends and panelists, namely Mr. Solomon Asamoah, who is the Chief Executive Officer of the Ghana Infrastructure Investment Fund. We have Mr. Uche Orji, who is the Chief Executive Officer of the Nigerian Sovereign Investment Authority, Nigeria's Sovereign Wealth Fund. We have Mr. Dave Uduana, who is the CEO of Sigma Pensions Limited in Nigeria and chairs the Africa Pension Fund Network, coordinated out of the Secretariat at the African Development Bank. I think it goes without saying, gentlemen, that we're all living in very unknown and challenging times. So I really want to start this roundtable discussion off by just really asking for you to just share with us your own analysis of the impact of COVID-19 on Africa's economy and how that's affected your industry, the institutional investment industry, and in particular, how each of your institutions have responded to this. And to get us going, I'm going to call on Solomon for his insights, and then I'll go to Uche and then Dave. Over to you, Solomon.
Thank you, Hubert, and thank you for the invitation to speak today, and good morning or good afternoon to all the listeners when they hear this. As mentioned, I'm the CEO of the Ghana Infrastructure Investment Fund, which is a government of Ghana-owned investment vehicle that was capitalized by the government of Ghana with $325 million, and our mandate is to invest in infrastructure assets in Ghana. So that's from our perspective. So I think everybody will agree that the COVID-19 has been almost a disaster, very difficult for everybody around the globe. It's been particularly difficult in various parts of Africa for a number of these issues and reasons. We have also had challenges in Ghana. One of the almost bright spots, though, that we have had is that our President Akufo-Addo, has been widely recognized as one of Africa's leading voices on this issue, and has really tried to get ahead of the pandemic and show leadership within Ghana. And so we are grateful for that. As soon as the pandemic hit us, he really prioritized 5 areas that he says was really important for his government. Firstly, he was going to limit and stop its importation as much as possible. It's going to try and contain its spread. Thirdly, it's going to try and provide adequate care for the sick. Fourthly, limit its impact on social and economic life. And then fifth, deepen Ghana's self-reliance so that we could rely on our own resources and our own people and our own industries as much as possible in the difficult circumstances. However, despite all of this, and he's been basically having weekly or fortnightly communications online and on TV with the population to try and keep us all very well informed about the effects. But notwithstanding this leadership, it really has had some very strong negative impacts on the country and on the economy. I mean, if you can, like many African countries, most people, there's a very large informal economy, and most people are paid often daily or even weekly. So if they can't work, they can't make money. If they can't make money, they can't eat. So that's a huge burden without the safety nets that many of the developed countries have had. So one of the things that the government did is that it did impose a lockdown and inhibited the movements of people to try and get a handle on this pandemic very early on in a situation. Also closed down the airports, and while they were open, was one of the first to impose checks on travelers coming in and enforce quarantine as necessary for people who were exhibiting some of the symptoms. Undoubtedly, these actions did slow down the take on the disease within the country. But like all countries, it has been increasing, and we've been trying to manage that. One of the, I guess, the most positive things that you can think about is that so far to date, although we have increasing numbers, the actual death rates are not as high as perhaps other parts of the world. So so far anyway, the gap between infections and deaths is still quite low on the death side. Long may that continue. But we had an additional problem, as other African countries had. The devastating drop in oil price as well also negatively affected the economy and had an economic impact. The stopping of visitors, local movement, also has had a devastating effect on tourism, on restaurants, bars, movement, aviation industry as well, as all suffered negatively on this. Reduction in imports and exports trade, and then increasing demands on the health sector. So that's been the effect on Ghana. We are still trying to battle our way through it and reverse some of the negative impacts. We as a government-owned infrastructure financier focus on investing in infrastructure. And what we've decided to do is to continue to focus and be part of the post-COVID recovery. We're still trying to make investments and make sure that our investments are continuing within the country. There has understandably been a rush towards COVID-specific interventions by most of the donor communities and international financiers and even the government of Ghana itself, and rightly so. We have decided that we're going to start really try and maintain our investments and also try and be ready for the post-COVID recovery. We really require the DFIs and the donors to play their counter-cyclical role, to really come and provide financing for our countries in these difficult times. And what we have also found that most of our funding, we don't fund projects ourselves. We always have co-financiers, and we find that the sources of co-financiers has also dried up to a certain extent. There's a lack of liquidity in the market, particularly long-term financing for infrastructure. So that's been an issue that we've also had to try and address. But we remain strong. We have about 6 of our projects which are in construction phase. We have continued to see construction happening and operations happening for our operational projects. So we're trying to refocus on the medium and the long term and survive the short-term liquidity crunches. We've also offered ourselves as a vehicle through which other funding can pass through for the economy of Ghana, given our on-the-ground knowledge and presence. And then finally, I would say we've been very careful to make sure that we haven't undertaken unsustainable interventions. We know that a strong gift is going to be required, a financially sound gift is going to be required when economic activity comes back. And we need to make sure that we remain strong and ready to play our role. So with those few remarks, Hubert, I'll hand back to you.
Thank you very much, Solomon, for your comprehensive overview. I'm sure you're giving our viewers a lot to ponder, and of course, you've really let them into your world within the Ghana Infrastructure Investment Fund, but also within GIF as an institution. Thank you. Uche, you've really, first of all, thank you for co-chairing the African Sovereign Wealth and Pension Fund Leaders Forum's continental response to COVID-19 and really establishing a very broad position about where African institutional investors can really support, public and private sector partnerships to respond to COVID-19. But as an institution, as NSIA, the Nigerian Sovereign Investment Authority, you've been very active, both on the investment side as well as on the strategic side. Just as Solomon did, please give us your response about how you see, and what you've gathered about the role that COVID-19 has really forced our institutions to address the impact that you think it's had on the African economy, and how NSIA has responded to that. Over to you, Uche.
Well, thank you very much, Hubert, and thanks everyone for dialing in and listening. I was listening to Solomon, I was thinking that sounds like Nigeria. We've had exactly the same impacts across the country. First point to make is that the rate of spread is steady. The death rate is still very low. Officially, the death numbers in Nigeria are still under 600 people dead. And this is after the first case was announced on March 11th, the first two cases. And at the moment, the rate of spread has been relatively steady. We get about 500, 600, 700 cases a day. But the good news is that we haven't had that many fatalities from this, and long may that continue. The second issue is obviously, and what the whole world is facing is we might find ourselves facing synchronized global recession. And we're not immune to that. We've seen oil prices drop to as low as $20. But we've seen it also rally quite strongly in the last month or so. We're now above $40. So all in all, the reality is that it's been quite a volatile environment for us. The third impact is had, obviously, is on the entire logistics supply chain. Interstate lockdown across the country, lockdown of airports, quarantining vessels that have arrived into the seaports in countries that is less than 14 days of sailing time. It's created all kinds of dislocations to the entire logistics and supply chain, which we are yet to see the full impact. And I say that only because the impact of that on the agriculture sector is one area where I'm particularly very sensitive. Because if this COVID ends up being followed by food shortages because of logistics issues and farming and all that, then we might have a more serious problem. Obviously, what's happened is also rising debts, and that is a global problem. And it's something we've also seen in the country where we've seen countries borrow just to get through periods where revenues have essentially collapsed. And so this is how we see it. The good news, like I said, is the fact that we haven't seen that many fatalities in Nigeria, and the rate of spread is slow, and it's actually quite low in many parts of the country. The hotspots in Nigeria are obviously 4 or 5 big cities, Lagos, Kano, Abuja, Port Harcourt, and 1 or 2 other cities across the country. So we feel relatively lucky when I think about the impact of this on the country when we think about other countries. Within the NSIA, how have we addressed this? What's been the impact on the NSIA? The NSIA has 3 pools of capital that it invests. The Future Generations Fund and the Stabilization Fund, which hold 50 to 60% of our assets, are invested in global markets. And those have done okay. I mean, we've had a significant rally between the months of April, May, and June. Quite a number of our portfolio managers, a handful of them are actually up on the year, and a few are sort of flattish to down single digits. So the market, the portfolios have been relatively resilient. Obviously, that is not as good a position as it was last year when we saw significant positive performance by portfolio managers. The other 40 to 50% of NSIA's assets are in the Nigeria Infrastructure Fund, which is basically what we describe as direct investments in the country. And here we invest in 5 key areas. We invest in healthcare, we invest in agriculture, we invest in toll roads, we invest in power, we invest in gas industrialization. And we also own a lot of financial market infrastructure companies, as we call them. Everything from a mortgage refinancing company, which we're big investors in, to credit guarantee company for infrastructure investors, all the way through to some of the things that we're working on, like creating a commodities exchange. So all of these are things that the NSIA is actively focused on. Our healthcare investment has been an area of focus for us, and that's proved to be lucky and both timely as this issue has arisen. And so we're going to find ourselves doing a lot more in healthcare, and this is everything from diagnostics to tertiary care for areas like oncology and other areas that we're going to be investing in. So we've had a few transactions closed there, and we intend to drive aggressively a few more over the next 12 months. Agriculture, we've been very active. We've run a couple of programs, one in fertilizer blending, where we've been very active, and here we've committed a significant amount of capital. We intend to drive that aggressively. We also own investments in companies that are involved in direct primary production and processing. And here we're going to find ourselves focused. One thing is clear coming out of the pandemic: food and healthcare seem to be on the top of everyone's agenda, and through our direct investments program, we're going to be driving more active roles there. Obviously, there's been a slowdown in terms of the other areas of our investments, especially areas where we need co-investments. And this is really my pitch to the CFA and the asset owners on this program. We see significant opportunities for Africa. And one of the opportunities we see is the world is waking up to the fact that you're seeing a concentrated supply chain in Asia, particularly China. And we're hoping that your risk management instincts will seek for diversification, particularly not just China, really, but in the entire sub-region. So we're hoping to find ourselves very active in industrialization, and some of the investments we're considering obviously range from industrial parks to free trade zones and areas where we'll encourage supply chain companies to move to Nigeria as part of diversification, and as also as part of the fact that we are really willing and open for business. The other areas where we see investment opportunities, and we believe for the world's sake of the world also, there's a need for diversification, is in pharmaceuticals. This is an area you're going to see us play a significant role in the next 12 months. We have concluded a partnership with a major university in the UK to advise on areas where we're investing in pharmaceuticals. A world where the bulk of the world's APIs and the bulk of the world's generics depend on China and India respectively is risky for everyone. One thing that has come out is when these things seize up, global supply chain seize up, this suddenly become matters of national security for a lot of people. We are open for business in Nigeria, in Africa, for these co-investments in these areas of vulnerabilities where we are vulnerable with regards to supply chains all over the world. The third is, look, all the programs we have, the fundamental drivers of our economy are still largely intact. Yes, I know we are going through a horrible period, but the world always has a way of healing and getting over these things. This has not been as bad as the 1918 Spanish flu pandemic, and I pray it doesn't get to be that bad, but we should always take advantage of the moment and look forward. And to that extent, we're opening up a lot of our co-investment vehicles in gas industrialization and climate change programs that we're invested in, and in healthcare and other infrastructure areas. So our view in NSIA is that whilst this is something that proves very challenging for the world, we see significant opportunities for co-investments, especially given the fact that our economies are proving and our people are proving a little bit more resilient in this time. So I'll stop there and hand back to Hubert. Thank you very much.
Thank you very much, Uche. Clearly, you've been very busy. I think this new normal is insisting that we all be probably a lot more productive than we were before. Not that we weren't productive before, but there's just so much to be done. And I'm glad and proud to see that NSIA has more than risen to that challenge, particularly with the focus along the same sort of lines that Solomon mentioned, and we're seeing across the continent with this sort of ESG-oriented focus on agribusiness and addressing the food security, the sort of sovereign supply chain related issues, and how can we now bring a lot of the manufacturing of some key and strategic sectors, particularly in the health sector, to the continent. So that's really well received. And the same question now goes to Dave, who obviously within his own institution and in his role, managing the pension fund network on the continent. Dave, please share with us your views on the impact of COVID-19 and how you've managed it from an institutional perspective. Over to you.
Thank you, Hubert. I think Uche and Solomon have touched on quite a number of things that one would have said. But I just make a few points. I think one of the things that is very clear and we've realized is just the inadequacies of the healthcare infrastructure on the continent. And I mean, I dare say that even the response to COVID is very contingent, very short-termish, but I think it's now an opportunity for investments in areas like primary healthcare, diagnostics, and even some large hospitals that could offer healthcare on a reasonable scale. I mean, clearly for us, the impact has been severe. A lot of our customers and the subscribers to pension funds are not able to meet their monthly subscription because a lot of them are not able to work. Companies have been shut down for 3 months, we're now 3 months into the shutdown. And, where I sit in Lagos is, if you will, the epicenter of the of the COVID-19 situation in Nigeria, and it's not even fully open. What we've done, obviously we're working from home. We found that one of the industries that's very resilient and has benefited from this is the data providers, the telcos, and that have shown the of this company that are listed on the local stock market, which we invest in. We're also seeing quite a bit of activities in the corporate bond end of the market, where some of the large corporates like MTN, like Bible Cement, have come to issue commercial paper and corporate bonds, which pension funds have invested in significantly. But I think overall, the market, I think it's the government, the response, I think, is been encouraging. I mean, there's obviously we don't have a lot of fiscal space to deal with this issue from a government finances standpoint, and that is understandable because before now the budget was already stretched. But what we see is that this year, without into a capital expenditure, a program of government will pan out. So I see opportunities in infrastructure. We have discussions around that whole infrastructure space. And the government just announced an ambitious program to sort of inject private capital into roads in Nigeria. I mean, that's an opportunity for large asset owners to co-invest with either the sovereign wealth fund or local pension funds. The other area we think that we're going to see more traction is in the area of maybe alternative, more specifically, sort of ESG or green financing. And also we're seeing some traction in the area of Sukuk, Islamic bonds. That was a Sukuk issue which was raised, which was brought to the market recently. Just about $500 million, and I think it was 3 times oversubscribed. And this is a way government to raise money now to finance roads locally. So overall, we've managed to, just to, I think, like most people, like you say, you hang in there. But I think for me, the bigger crisis, and because Nigeria is largely a informal sector market, the saying here is that you're likely, people on the street tell you that they are more likely to be killed by hunger than by COVID-19. So in spite of what the government have done, it's the law have not affected, because I think Solomon made the point that a lot of people work on a daily, weekly basis, and if they don't go out for a day or for a week, they don't get paid. So that is the challenge. And I don't know how this is really going to play out. What the fatalities have been low, but the numbers are high, and the government. So it's a tough situation. And on the front, returns has not been as have not held on as well as we would have wanted. Our plan at the end of the year. Stock market is took a nosedive. It's recovered quite a bit, but I think the bigger challenge is that the internationals are all looking for ways to exit the market, and it's putting some sort of strain on the foreign exchange markets. I think Central Bank of Nigeria is trying to manage that. But I think this case is similar in most African countries. The pension funds tend to be invested in local corporates, government bond issues, and the case is the same. But I think that on our side, we're still a lot of liquidity. The investment space has been significantly narrowed. Some of the more active private equity players who are looking to raise monies, I think they've had to, put those things on a back burner to see how this pans out. I mean, we're looking at investment for this pandemic in a real estate fund, but that's been put on the back burner because think about it. Today, most people are working from home. So if you are building office properties, it's going to be significantly challenged, for you to get occupancy. But on the bright side, I see that now the move to digital and work from home, and particularly the move to digital, is no longer an option. It is something that you have to do. So it's almost like leapfrogging, if you will, to the next phase, which is digital. And I see huge opportunities in terms of investments in that space. So for me, I think some of the large asset owners who are looking at Africa should always remember, I think Uche also made the point, it's a young population, it's a growing population, And this time will be over, and we believe that this crisis will come and go, and Africa stays, and there are huge opportunities. I think healthcare is one area that is most encouraging, and I'm most optimistic about. I'm also very optimistic about the whole telco space and data and fintech, more because people are learning. Most people have learned how to do things digitally, and I don't think they will go back. So I will just pause there and hand over to you.
Okay, thank you very much, Dave. Some really good points there, and in particular, it's really interesting the way that you've introduced the Islamic finance component. I think that we've been involved in many discussions, and there's not enough emphasis or focus on that as a potential area of interest. And of course, everything is digitization, but I think, underlying that is, working with governments to really put the policy environment in place to be able to accelerate that. So I think that's another excellent point. And linked to that, the ability for the continent, who hasn't necessarily, we haven't necessarily been fully digitalized to date. We have an opportunity to leapfrog, a lot of the different legacy issues that other parts of the world have. So interesting opportunities there, indeed. In my little introduction, I did mention that one of the objectives of this discussion is to provide tactical insight. So we've really sort of set the scene here, I believe, by just sort of touching on the key issues associated with COVID-19, how we've handled it. But I really want to start, getting a bit more granular now, because I think that we've perked the interest of a lot of the viewers that are participating and sort of working with us on this round table. So I'm going to go to another round of questions now, which really seeks to get your tactical insights on the do's and the don'ts of investing specifically in African infrastructure. All the talk now is creating that resilience, that resilient infrastructure, that ESG and climate-friendly green infrastructure. And then also, share with us your views on the do's and don'ts of investing in African public equities. I'm going to switch it up a little bit, and I'm going to go straight to you, Uche, please, to give us your views. And then I'm going to go to Solomon and end up with Dave. Over to you, Uche.
I think in terms of tactical strategies that we are looking to adopt, frankly, I think at the moment there are quite a number of areas where we believe that we need to cooperate and drive real investments. Look, number one, and when I spoke earlier about industrialization, I'm very keen to drive this because the future of Africa's prosperity and the opportunities that Africa presents itself in real tactical investment opportunities in areas of industrialization. And I speak to gas industrialization, for example, as a random example. And this is an area where I see synergy between the petrochemicals, urea, methanol, ethanol, all of that stuff, taking advantage of the big gas opportunities in Nigeria. Number two, and here we have some real life investments in hand that we are going to be raising capital for. And we're welcoming and open to people to partner with us in some of these areas. And this is speaking to a country that flares, on average, monthly 2.4 billion standard cubic feet of gas. It's being flared. And so that's something that has been a program to reverse that. And at the moment, the tariff and the fine for flaring gas is very high. So that's really creating disincentive for the flaring to continue. And so investors have been welcomed into a program to invest in this area. And this is ranging from gas to LPG, gas to petrochemicals, gas to urea and methanol, and then and gas to power. So we're very, very keen in investing in that whole middle market area, and this is one area. And I did speak, obviously, to pharmaceuticals and basic materials, and healthcare. And it's very clear to me, really, that the whole world is dependent on a handful of companies to supply N95 masks is an embarrassing situation. And I think this is something that is room for low-tech manufacturing that should be diversified. And here we are also very actively looking for co-partners to advance our investment opportunities there. And when I look at the point being made about Africa Continental Free Trade Agreement and the opportunity that presents, I am one that is, on the one hand, very excited about it. On the other hand, I see it as a challenge for African countries to position themselves properly for fair trade to occur. Otherwise, it's not going to be something that will succeed. If people believe they're being taken advantage of, then certainly it will fail. And here's what I mean by that. The last thing we need is, a company docking somewhere in China, or the Chinese company docking somewhere in some country and then using it as a landing post to export stuff into Nigeria. Now, obviously, that is something that needs to work in a fair manner because no country will allow itself to be taken advantage of like that. And to that extent, to the extent that we believe, and it's arguable in the minds of a lot of people, but we still believe Nigeria presents the single largest market opportunity in Africa. And as a consequence, we also need to prepare ourselves to compete in this market. And so, and this will be, in my opinion, the future of why things like continental free trade will succeed. And so the industrialization area, and I think, Hubert, you and I have spoken about this extensively. And I think we are coming at it with a slightly more robust solution that includes investing in industrial parks and investing in free trade zones and investing in areas where we might be able to address this. So these are the specific areas. And I think, obviously, working with you, Hubert, we've also been able to put out certain areas of co-investments that people can have a look at. The point here is that we've done everything at NSIA, from co-investment funds, which we've launched, registered, to, and it's proper funds with opportunity for third-party investors to come into. We've also launched our own direct investment programs into which people can just pick and choose what areas to participate in. So on a more granular basis, the clear message here is, but quite frankly, I'm also mindful of the fact that capital right now in the world we live in is a little bit not as easily available. Most of the countries in the world today are battling to save their own environment. So I'm not oblivious of that fact. But I'm also pitching an argument here that says we can deliver you superior returns in some of the areas that may be of interest to you. And I think in the way we work, some of the infrastructure areas and some of the direct investment areas we're looking at returns, somewhere in the high teens to low double digits in dollars. And I think this is really low 20s in dollars. And this is really the opportunity that we are looking at in terms of some of the gas industrialization opportunities I've mentioned. If there's one area where I think people can look to partner with the NSIA, these opportunities. Yeah, there are obviously long gestation periods to develop them, but there are a few that we've gone through 1.5 to 2 years of development already. And so these are ready, in my opinion, to welcome capital. So Hubert, I don't know if there's any other areas you want me to touch on more specifically, but I'm mindful of everyone's time. Yeah,
thank you. Uche, I wonder if you can just give us your sort of top 3 do's and don'ts when investing, and give our audience a look through the Uche Orji NSIA lens of do's and don'ts when investing in Africa.
So I think, we also at the NSI will view ourselves the same way you view Africa, and that's partly because we're also a dollar-denominated fund largely in some of the investments we make. So when you come into Africa, obviously, for most of the economies, the currency risk is one of the first things you need to stick to manage. And so when we look at areas where we're investing in, the only hedge you can have is superior high margins, or areas where the pricing is indexed. So look for ways to manage that. We have been able to largely manage that as well, the investment opportunities we have made, and that is choosing some of the subsectors that are very open to dollar type investments so you can hedge properly. And like I said, the only natural hedge for you is high margins and products where you have pricing that is indexed to the dollar. Number 2, the right partnership is very important. And I think for a lot of people that remains a big area of challenge and mystery. And this is part of the reason why an organization like ourselves will hold ourselves out as a partner of choice for a lot of people. And I think choosing the right partner for you is very, very important. Number three, and I say that only a little bit carefully, because that thesis is being challenged of late by the whole COVID situation and a few other things that have happened. It is not as scary as it seems when you hear it from outside. And I used to make, and so be a little bit more courageous as you come into the market. Choose the right partner, choose the right subsectors, and quite frankly, take the leap. And I think for me, the last thing I'll just encourage people to do is look at Africa. And don't look at Africa as an asset class, right? That's just one mistake everyone makes. There's everything from debt to equity, and there are various markets and various countries in Africa that are very different. So I hear people think that, because when I was in New York, London, people talk about Africa as just one big monolithic market. No, it isn't actually. And I take your time to really make sure you are digging into the real details of each market dynamics. There are really fascinating opportunities here. So I'll recap. Number one, obviously, the currency risk people tend to point to is a challenge, and I think it's something that is manageable if you pick the right subsectors and pick the right product areas. Number two, look at the partners that you work with very closely, and be careful, and then choose partners of choice for you. And the of these opportunities now to choose the right partners. There's Dave on the line, there's Solomon on the line, and I think they'll guide you very, very, very properly. And then the third, obviously, in my opinion, is be more granular as you invest and not look at it as one monolithic asset class.
Fantastic. Thank you, Uche, for those insights. And I'm going to move to Solomon now. Solomon, I think you've done it all. I think you've worked with the World Bank Group in the investment division of the International Finance Corporation. You then moved to Nigeria to set up one of the largest development finance institutions with a focus on infrastructure. And then you went to become the most senior operational infrastructure investment executive at the African Development Bank. We're really looking forward to your lessons learned and insights and strategies and tactics that you've picked up over that rich and diverse experience of yours. So please share with us your recommendations on the do's and don'ts when investing in African infrastructure and public equities. Over to you, Solomon.
Thank you very much, Hubert. Yes, I have many scars on my back still from my last 20 or so years in Africa, but also a lot of good lessons I learned as well from different perspectives. I think there's a few things that I would say. Firstly, do your homework. Africa there was an old saying, it doesn't get said as much anymore, but before it used to be, Africa is not for sissies. I would say Africa is not for remote control investing. So you really need to do your homework, get access to the right information. And as Uche said, get the right partners. Partners that see the world the way that you see them, that you have a common view of what you're trying to achieve and who you can work closely with. Because there will be dynamics on the ground that you will miss if you are overseas or outside of the specific country, let alone the continent. But the other thing that I would always say, and I always stress this, is there's a huge amount of wonderful opportunities where you can make very good returns. Investing in Africa for the people who make a lot of money is a very well kept secret. All you hear is the horror stories, but the people who are quietly making a lot of money and making good investments don't tend to make so much noise. So don't be fooled by that. There's a lot of good opportunities there to be taken advantage of. In your earlier point about climate sustainable investments, I mean, for us focusing on infrastructure, we just cannot avoid these issues, and neither should we avoid these issues. I think they're at the center of every project that we look at. We have to make sure that we follow the highest standards of environmental and social investing, as well as climate sustainability, for two main reasons. Number one, it's the right thing to do. Who wants to be involved in a project which destroys the livelihood and local people around the investment that you've done. Nobody wants to be in that position. And right now with social media and attention so quickly generated, you don't want to be the institution that's being lobbied against the damage that you've caused to the environment of local people. But secondly, equally importantly, if you don't, you won't be able to raise your financing. Nowadays, the sensitivities around being involved in projects which don't take either climate change or environmental or degradation seriously is that you won't be able to raise the financing both from DFIs and from the private sector. And so those are areas which are very important that you have to focus upon. One of the challenges you have, or we have, when we're trying to look for infrastructure investments in Africa, is that a lot of the basic infrastructure in many other parts of the world were put in place by the public sector. And then the private sector finances of infrastructure stood on top of those basic public infrastructures to then take them to the next level. In many cases, Africa is, in my thinking, sometimes a little bit unfairly, expected to do very basic infrastructure with private sector funding. And of course, the numbers, the return numbers don't always work in that scenario. And again, here I think the importance of donor funding, complementary funding, blended finance, concessional funding, targeted and structured in the right place to make those investments attractive to the private sector is extremely important component of financing. And again, to be able to access those funding, you need to make sure that your projects are meeting international standards of climate friendly policies and sustainabilities. So I think all roads for infrastructure space anyway lead towards those. Now, the final thing I would say is that people always say that it's very difficult to close infrastructure projects in Africa, and it has historically been. But I honestly believe that it's now getting easier. There's now more and more examples that we can follow and learn from and move forward. I mean, for the Ghana Infrastructure Investment Fund, in the last 3 years, we've closed 12 projects in infrastructure in Ghana, ranging from the new airport terminal to the power sector, to expansion of the second largest port in Ghana, to a number of hospitality, tourism related projects, to projects in the ICT sector. And all of them have backed Ghanaian sponsors. And all of them, I would argue, have been done to international standards. And for every dollar that GIF has put money in, we've managed to raise $10 from other sources, including DFIs and other private financial institutions, which I think is a testament to the standard that we've managed to achieve in our projects. So my point is that it can be done, and it can be done quickly, and it can be done the right way. And again, if anybody out there would like to take some exposure in infrastructure sector in Ghana, please come and talk to the Ghana Infrastructure Fund. We'll be happy to work with you because there are good opportunities in Ghana to take. Thank you, Hubert.
Well, that was exceptionally compelling. This is Rob. We lost Hubert for a second, but I'll just sort of pick up here. Dave, I thought Solomon's discussion of the blended pattern of funding was really interesting. I wonder if you could expand on that, how you see that, also how you see the impact and the necessity of ESG now in infrastructure. I'd also be interested in hearing any thoughts you have on subsectors of infrastructure. Solomon was through a few of them, Vienna, Ghana, and that's really impressive. But in most of the rest of the world, risk varies across different types of subsectors of infrastructure. So any thoughts you have on that?
Okay. I didn't quite get your point, but I think what you asked is the way we look at infrastructure, embedded finance, and especially in the area of ESG. Is that the question? Okay, I'll just respond generally. I think we haven't done a lot in infrastructure. We don't invest directly in infrastructure. We invest through infrastructure funds, but we have done a bit on the infrastructure bond space. I spoke about the green bond, I spoke about the sukuk, which we have done. And we just starting to, we just started discussions around a program that will involve co-investment, pension funds and sovereign wealth fund and other internationals in infrastructure in a big way. So on that area, I think maybe Solomon is ahead of the curve, and really this is Solomon's stuff. I was going to speak about other opportunities and, sort of the question that Hubert asked about the do's and don'ts of investing in infrastructure and public markets. I think on the public, and I'll talk about a bit about the public market and the private equity and private markets, but not specifically on infrastructure. I think one of the things at the point is the market share is not as deep as in the Western world. So you can't, one of the things you don't do is that you don't come and you buy the market. You have to be selective, you have to understand the name you're backing, and you need to have a longer time horizon. I don't think you could come into most African countries on the public market and make money in you come in and in 12 months or in 24 months you want to exit. By all means, you can do that, but the way to make money in Africa is to be long term, and there's a lot of money to be made. And I think it's saying that those guys that are making the money don't do conferences and they are busy making the money and not speaking about it, because they speak about everybody who jump on the bandwagon. Very attractive pickings in the market. Market is largely concentrated around the banking, names, telcos, food, and cement. Dividend yields are very high, as high as 15%. One of the things and one of the lessons you can is to buy when the currency has just been adjusted. Most African countries, especially commodity producers, go through these cycles. Every 4 or 5 years, the currency gets adjusted. The currency is not free flowing; it's managed. It's managed flow. So once you get adjusted, that is probably the best time to come in, because at that time, once it's done, that over the next 4 or 5 years, the currency might largely stay the same. Currency hedge is expensive. So what you do is that you do the natural hedge by buying companies with very good margins, and those margins give you the attractive yields, even in dollar terms. I think that the other point to make is that if you're betting on the private space, obviously it's better to invest through a private equity fund that is investing in these African markets. Private equity is a growing asset class on the continent. Most of the more prominent names are invested across countries, so you can get exposure. You can get exposure through a fund to many of these African countries, particularly countries like Nigeria, Ghana, Kenya, Southern Africa, Egypt, and to a large extent some of the more francophone countries. However, one of the things that we've seen that private equity also the challenge is exit, and so what we advise is that you invest in funds that have self-liquidating instruments that are able to sell to strategies. On the exit side of private equity, the predominant way of exiting is to a strategic or trade buyer. Another way is through the secondaries, because private equity funds have raised a lot of money and there's a lot of dry powder looking for new deals. IPOs are difficult because, like I know, the markets are shallow. The holding period is a tough one, and one of the things that I see again as the more I look at African markets and the instruments and the vehicles that worked in other markets in Europe and the US is that the typical 2 and 20, 5, 10 year, 5, 7 year deal private equity is tough, because Africa, I think you have to grapple with infrastructure challenges, whatever business you are dealing with. But I think it's not for the faint heart. There are monies to pay and people are making those monies. So you need longer term vehicles. Maybe if you start with a permanent capital type vehicle or listed strategies where you're able to buy, you're able to access liquidity on the local market. And this is something that we see some players already thinking about. Another big opportunity in the credit space. Obviously, one of the ways to play the credit space is to buy, to invest in a bank. But the other way is to, invest in some of the credit vehicles that are being set up. I think the DFIs are moving a bit now from equity, because if you think about it, Africa traditionally is a credit market. Most businesses in Africa were built through, some sweat equity, some equity from the founders, but largely through borrowing from banks, bank loans, commercial cars, and corporate bonds. The credit market is huge, and because African markets are fragmented, they're mostly informal, they are now, most of them are getting more institutionalized. It's difficult to, plug in the private equity model in some of these markets. So, an alternative strategy on the credit side, where you are giving them, you're investing in credit instruments with an upside, but then what these vehicles or funds do is that they help these companies to institutionalize and get to the next level. But for me, this is really an exciting opportunity. We are seeing loads and loads of that. And I found companies coming to raise debts, 3-year, 5-year, 7-year debt corporate market that is growing and it's really exciting. So I would say that one of the things that you cannot do is find co-investment partners. You may find partners that you're doing deals, but find co-investment partners who are on the ground. The typical co-investment partner would be your sovereign wealth fund or your big pension funds who are investing alongside you, are closer to the issues. They can help you deal with some of the issues. They have a skin in the game. A lot of time, people tend to trust the advisors and the consultants. Consultants, as you know, they don't have any skin in the game. You need to work with co-investment partners, either pension funds, credit fund, private equity funds, sovereign wealth fund that are in the ground and putting money on the field. But look, overall, I would say that it's exciting time, and in Africa it's not for the faint heart, but it's not as bad as it's painted. There are rich pickings, there's money to be made on the table, but you have to roll up your sleeve and you have to come on the ride. I'll just pause here.
Thank you. Thanks, Dave. Really good insights there. I think one of the things that we're seeing a lot in the continent, and I think Uche will identify with this, in the African Sovereign Wealth Fund community, I think they've basically received many different definitions and descriptions. I think we went from a straightforward sovereign wealth fund to, well, let's get involved in a bit more development now. It should be a sovereign development fund. And then we went from a sovereign development fund to say that you have a catalytic role to play in attracting and facilitating co-investments. So you're almost like a sovereign investment promotion agency. But now one of the other things we're seeing and hearing a lot of, Uche, is this role of creating de-risked instruments, credit enhancement type platforms to create that more predictable risk profile for transactions. So I'm not sure if it's, I'm not sure how you would describe that particular role in the context of your institution, but I'd be really interested to just, if you could just quickly share with us your views about how you approach the whole issue of de-risking transactions and the market, and maybe just let us inside your infra credit story just a little bit. Thank you very much.
Sure. All right. I think the first thing is these markets are defined as emerging market because there are all sorts of market infrastructure missing that creates voids and dislocations, right? And if you do not solve for those, you will not, it will not be easy to attract, even for you to invest as a sovereign wealth fund. So I'll give you an example. When we looked at investing in infrastructure, the risk management tools and the market infrastructure tools that were available easily in New York and London were things you took for granted, but you come here and they don't exist. And that was the reason why we had to create an infra credit to make it easy for people to invest. And infra credit will provide some of the support and risk mitigation tools for those investing in infrastructure. So infra credit full name is Infrastructure Credit Guarantee Company. Really, it's Infrastructure Credit Guarantee Company. So that's the reason why we created that. The same thing we saw in housing. You look at housing and you realize that without the back-end refinance of mortgages, a bit like what you have with Fannie Mae in New York, in the US, it is difficult to create low-cost housing markets. It's really about creating an institution that allows you to have a future and invest in the future, be able to take mortgages and refinance those mortgages, and therefore then primary mortgage banks can create more mortgages. And so we took a 21% stake in that company because we can't do housing ourselves directly, but we can create a financial market instrument that enables people to invest in housing. So we did that. And so the same thing we're seeing now as we invested in agriculture, in fertilizers, in primary production, in processing, we realized that the need for a proper commodity exchange. And so we've been trying to drive one, and we're willing to partner with third-party players, and we're also sponsoring one by ourselves. Whichever comes first will converge. But these are some of the dislocations that exist in these markets. And so having to solve them is very important. And so we ended up creating what we call a financial infrastructure subsector. I'll give another example. We own 14% of a new company coming up called NG Clearing. NG Clearing is going to enable the derivatives market. Again, very important in creating a liquid equity market that actually makes markets work. We help sponsor Family Homes Funds, which is a fund that creates funding for low-cost housing. And the Development Bank of Nigeria will also play the role there. So this deals with small and medium enterprises. So sectors that are, and if you do not have all of this together, all functioning, it's going to be difficult to have a fully functioning market, be it for infrastructure, be it for direct investments. And without those institutions in place, you will remain an emerging market. And until you have those places, it's difficult. Until you have those in place, you cannot make that leap. And so that's the reason why we find ourselves enabling those institutions. And back to the definition of sovereign wealth fund, sovereign development fund, catalytic roles. This is when reality hits you. You have a significant chunk of capital, but you can't invest it. I'll give you an example. The NSI started with $1 billion, and we've grown now significantly between the NSI's own capital plus third-party assets we manage, plus assets we manage on behalf of government. Total assets under management for the NSI's own core assets is about $1.75 to $2 billion, actually slightly over $2 billion. And then we have third-party assets we manage for government that in total is over $1 billion and rising quite frequently to $2 billion. So all together, these are the assets under the NSI's management. So of which, let me be clear again, direct contributions made by government is $1.75 billion. Earnings made by the NSIA takes it to over $2 billion in total of NSI's core equity. And then there's all these other third-party assets we manage for the debt management office, for the federal government of Nigeria, for other entities in government that have given us capital to manage for them, and for which we earn a fee. Within our infrastructure fund, which is currently, somewhere between $750 to $900 to $850 million, our core infrastructure fund, and I speak to that only because the earnings so far, it's something that moves up and down because depending on the market. We have actually not been able to deploy a huge amount of capital. In reality, we have committed a lot, but the drawdown has been slow, and that's because developing these assets takes time, and we're doing a lot more primary infra than buying secondary positions in existing entities, right? So, we could easily deploy all that capital, buy a piece of the airport, a piece of the seaport that's already existing, but we actually want to do something incremental. So to some extent, that is what you're seeing as the real reason why the capital deployment itself has been slow. And why has it been slow? It's been slow because of some of these dislocations in the marketplace, which we want to help get fixed. And now we've fixed a couple of them. We're seeing, quicker deployment of capital, and that is something that we're feeling very excited about. So I will say this is not about mission drift. And I think it's important that is clarified. The reason why you're finding this deflation of some of them, and this is not just an NSI problem, it's something we've discussed across other sovereign wealth funds, is the reality of putting capital to work, especially when you have an infrastructure or direct investment mandate. It's forcing you to actually go on and create institutions to enable that to happen. Unless you do that, it's going to be difficult. Very critical, important building blocks. Now, catalytic role in investment, that became a function we added. And we added that function because we're realizing that there's a lot of capital that wants to come into Nigeria. wants to come into certain products, and they just need a little bit of hand-holding and a catalytic role being played by the NSI. We have the depth, we have the capital, we have the expertise to actually develop projects that will make people want to commit. And right now, quite frankly, I will throw out one challenge to the CFA asset owners, particularly in New York and in the USA. 7 out of 10 calls I'm getting now for inbound co-investments is actually, believe it or not, coming from China. No, not debt, not sovereign debt. I'm talking about equity. And that's a very interesting shift. And that's coming out of entities set up in Hong Kong that are now coming to look at filling out the equity base in some of these projects. Very interesting, very fascinating. And right, and I mean, we're looking at it, but we haven't really committed to doing business with any of them. But it is something to say that, you know, there is competing capital out there in the market. I think one of the times when we had this call in the past, Hubert will remember, it was a Japanese investor who said that, you know, he's calling people and people are not picking up the phones and something like that. So my sense is that, look, we feel that once we are ready, well-developed projects, everything is lined up properly, and we gather in the marketplace, it's going to be easy to raise capital for us if you have all this installed. So that's why you've seen the definition evolve. And it was very clearly strategic. It's not a mission drift. We need to fix these institutional gaps that exist, be it infra credit, be it mortgage refinancing, be it development bank, be it family homes funds, be it NG clearing. All of these things are very important to get fixed first. We have the equity, we have the depth, we have the experience, but more importantly, we need to do this to make it easy for us to then invest capital. Second, we realize that people want to invest in the marketplace, and we need to create vehicles for them to come in. And this is one of the things we did in agriculture very successfully, right? So we created a company registered in Mauritius, like any other fund, which was seeded by ourselves and an old mutual-owned company called UFF, which is a specific agriculture investor. Two of us put some money together. We're raising third-party capital. We deployed that now. The first tranche of capital we raised, and we're now on to the second tranche of capital being raised for the expansion in agriculture. So that, I think, is, you know, the reality of the situation in Africa. And this is why I made a joke in the past, calling the sovereign wealth funds of Africa sovereign wealth funds a bit of a misnomer. You have to call them sovereign development fund, because the reality of what they do is actually helping catalyze development.
Very, very, very well put, Uche. I think the quiet truth that you didn't also add to that model is that all of these market development activities that you've just outlined are profitable. You actually do it and structure it in such a way that you've actually created a commercial instrument that in some cases can give you equivalent or better returns on market development related infrastructure than you get in OECD markets. But I'm going to jump now in the interest of time to Solomon, because I think Solomon is another personification and an institution that can reinforce this dynamic in the African market. One of the things we continue to hear is that long-term institutional investors will not look at early stage projects. We obviously want to go into something that's cash generative, get access to those cash flows, a bit more predictable, even if we have to pay a bit of a premium to get access to them. You know, it seems that the model that you've just mentioned, which has its commercial merits, and the way that the Ghana Infrastructure Investment Fund, that has a clear mandate within its broader mandate to also look at early stage greenfield project development opportunities. Solomon, tell us a little bit about that. Is the myth dispelled? What's your experience with infrastructure project development? Over to you.
Yes, thank you very much. Very true, Hubert. I was just saying that we have to be careful. You and Uche are giving away all of our secrets here. But it's very true. I mean, if you want to invest in infrastructure, you have to do the preparatory work. They don't come in a nice ribbon already prepared for you. Now, the good news is that there's now beginning to be more and more of a track record of what needs to happen to make these infrastructure assets close. And we as Ghana Infrastructure Investment Fund, if there's one underlying philosophy behind our setup, was to try and make things happen where they weren't happening. A lot of African governments have now accepted that they don't have the funds to roll out their infrastructure, and they understand that infrastructure is critical for development. And so if they know now that if they need to roll out the infrastructure, they need to attract the private sector involved to attract the private sector, there are certain rules that you have to put in place, or else they won't write a check. Doesn't matter what you say, how nicely you say it to them at investor conferences. When it goes to their credit risk department, if there are certain things they don't see in the investment, they will not write a check for it. And it's as simple as that. So what we have done as the Ghana Infrastructure Investment Fund is try and take those lessons to understand what structures you need to put in place, what risks you need to mitigate to be able to attract financing from international financiers or DFI financiers or even local financiers. There are certain things that lenders and equity participants need to see. So if you don't package your project, your product, or your project in that way, you won't get the financing. The good news is that when you do, often shortage of financing is not the issue. In fact, you might even have a competition for people trying to get involved in your project when they're structured appropriately. So I think that's a very important lesson to learn. Second point that I would say is that project development, as you describe it, is extremely important to increase the volume of projects which are bankable for institutions to finance. I think most of the time for over the last 10 years, we've been doing project development in a suboptimal way, generally. And that has been focusing on theoretical feasibility studies written by consultants who themselves have never managed or operated anything or raised any financing for projects, but they're the one writing reports as to whether this project can be bankable. I think we have to get practitioners to be doing the project development. Engineers, investment bankers, financiers, sponsors, people who have actually developed and financed and managed projects. Those are the people that need to be doing the project development work. The challenge has been those people are usually highly paid, commercial-minded individuals or institutions. And a lot of the project development funding has come from donors and DFIs. And they find it very difficult to provide their donor money for these private sector, high-earning individuals and institutions. I think we need to break that. And I think we're starting to see signs of that being broken. Now, private sector commercial project developers can access more and more frequently project development funding from DFIs, donors, and from other institutions. So I think that's definitely a move in the right direction. The third thing that I would really highlight is that we really need, and I can use GIF as an example, we really need more stake in our project, infrastructure projects from our local, from our countries, from our governments, but not in the traditional government stake way, but in a way that the private sector can see government commitment towards the project, but can also be comfortable that that government commitment will not also bring the political baggage that often is negative to their transactions. To me, the establishment of an institution like GIF, which is government owned, but does look at the world as a private sector investor looks at it, does take the same risks as private sector parties or partners in the project, has the ability to access government at the very highest levels to unblock problems, but still maintains a degree of independence from day-to-day government control, is absolutely the right kind of model that I think many of our countries in Africa should be pursuing. GIF are playing that role, NSIA are playing that role in Nigeria, AFC is playing that role in Nigeria, and institutions that have a fundamental understanding that government ownership or partial ownership, as well as a private sector outlook, is a very important way to give confidence to overseas finances and investors. If I, for example, based in Ghana, was looking and I had the ability to invest in Nigeria in infrastructure, I would call Uchi up first and work with him to see what opportunities there are in Nigeria for me to invest in. Because I know he understands the lay of the land, and I know he sees the world the way that I see it. So I'm more likely to get a successful outcome if I join hands with him. And I hope he feels the same way, vice versa, if he was coming to Ghana to look at an infrastructure investment. So I think a greater collaboration between sovereign wealth funds, if you like, for Africa, is also something that we need to explore more. And I think it will be very opportune for us to look at it. So I'll stop there, but just my bottom line is that there are many, many opportunities in our countries for private sector financed infrastructure, but they just need to be structured correctly, and the governments need to know how to structure them and leave them for the private sector to drive them. Thank you, Hubert.
Thank you very much, Solomon. I think what we've been able to accomplish with this roundtable is, much more definition and color on the model for success in many respects for institutional investors to be able to access the market, de-risk transactions, and identify the most appropriate and optimal partnerships to be able to, get the greatest chance at success when investing in the continent. And that's principally to work with peer institutions like our own, pension funds, sovereign funds that have access to deal flow, that have the capacity to create the market infrastructure to be able to enable and scale those transactions in a significant way, and also to be able to participate and lead with one's own capital and one's own high-level diligence standards. I'm going to give it to Dave now just to say his parting shot, and then I'm going to wrap up and then pass over to Sanjay for the closing remarks.
Thank you, Hubert. I think just on the issue of subjects of collaboration, I think we've seen it work well in Nigeria. On the back of infra credit guarantees, I've crowded in quite an amount of pension fund investment in infrastructure, and it's something that I think has also worked in the mortgage space, and we're looking to do something similar with the family homes fund in the housing space. I think that the issue with the pension fund, as you know, the pension fund, whether it's in Nigeria, Ghana, it tends to be more forward looking because there's this idea of investing African monies in African countries, and rightly so. And so when you find it very quickly, you run out of investment opportunities. So we need these market enabling institutions that will create the vehicle that will crowd in the pension funds. So Nigerian pension funds is about $30 billion, but not more than 10% of that is invested in either infrastructure or private equity or housing or alternative space. So there's quite a bit of money sitting by the sideline, waiting for opportunities, that will be enabled by some of these institutions. I really think that, and I have to applaud what Uche has done at the NSIA. We continue to work with them. We're currently in one discussion that is, hopefully if it pans out, we'll crowd in quite a bit of pension monies. And maybe at some point we might be able to see things, us investing, in Ghana, infrastructure investment alongside Solomon, who has expertise in this area. As you know, pension funds, we are typical investors. We like to come in when the bill has been booked because we don't want to take a lot of it. But to the extent that those people that are making creating the market enabling institution that are doing project preparation are getting rewarded for that effort. I think it works well. So I think my final parting shot is that your best partners to invest, co-invest in Africa are your sovereign wealth fund, your infrastructure funds, and your pension funds. They know the lay of the land, their experience, they hear the monies are here, and more importantly, they are long-term investors. Some of them backed up by government, some like our institution, private sector, but highly regulated. You cannot go wrong, partnering with us. But you have to be there to do those deals, and you have to be there for the long run. But there are money to be made, there are returns to be made, and I think we are ready. Thank you.
Well, thank you, David. That's a great way for us to wrap this up before I hand over to Sanjay. I think many of us on this roundtable, Uche and Solomon, during our COVID-19 World Forum, one of the key big recommendations was for us to really double down on a pan-African co-investment platform that's premised on being able to really mobilize the domestic pools of capital with the view to being able to catalyze the global multi-trillion-dollar pools of capital to be able to participate in what I think Uche described as some of the outsized double-digit returns relative to what we're seeing in some of the OECD markets. So I'd encourage the CFA members to collaborate with this Pan-African initiative through the African Sovereign Wealth and Pension Fund Leaders Forum and get access to the many people like Uche and Solomon and Dave. So you can look at different asset classes, you can look at different jurisdictions and really collaborate. Because I think one of the big things that we've learned from the COVID-19 crisis is that, you know, one, we need to coordinate wherever we can. And two, a lot of our investments, we need to correlate. None of us can be shielded from some of the negative issues, but the more we have these strategic, collaborative, and sort of correlative approaches to investment, the more transparent and profitable and effective we can be. So I'd just like to thank all of our roundtable members, Uche Orji from the Nigerian Sovereign Investment Authority, Solomon Asamoah from the Ghana Infrastructure Investment Fund, and Dave Uduana from Sigma Pensions. It's now my pleasure to hand over to Sanjay Arora, who is the Managing Director for Institutional Fixed Income and Capital Markets at Raymond James, and he's also a board member of the CFA Society New York. Over to you.
Thank you very much, Hubert, and thank you very much, Uchi, for the excellent presentation. I am reminded of a quote from Nelson Mandela. He once said, "I never lose. I either end up winning or I end up learning." Hi, my name is Sanjay Arora, and I'm also the board member of CFA New York. Thank you very much to our organizers, in particular Tom Brigandy, for bringing such a wonderful event. Thank you to our CFA staff members who have been really working hard during the COVID-19 and making sure to bring all these webinars to us. And finally, thank you very much to our today's presentation. Again, thanks to Hubert and Uchi. Well, finally, thanks to you for joining us today. Please make sure you log on to cfanewyork.org. We are making sure during this period to bring you as many webinars as possible. So make sure you keep track of them. They all are on our website. And if you miss any of the presentations, you can always log in again to cfa.newyork.org. We record all the events, so you can look at the past recordings. Hopefully, we meet in person soon. Take care. Be safe. Bye-bye.
Doing business in Africa. You can't afford to be without Africa Investor.